Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to your U.S. Market Update. The S&P 500 struggled on Tuesday, bogged down by a drop in Oracle shares amid investors' worries about the profitability of the AI rollout. Wall Street also looked for more developments out of Washington with the U.S. government shutdown in its second week. So let's recap the numbers quickly. The broad market index pulled back 0.4% or just a shade under to close at 6,714, snapping a 7-day winning streak, while the Nasdaq Composite fell 0.7% to finish at 22,788. The Dow Jones fell 0.2% to end at 46,603. As mentioned, Oracle led a decline in tech stocks after it was reported that the software company is generating much lighter margins on its cloud business than analysts currently estimate, and that it is losing money on some of its deals for rental of NVIDIA chips. Oracle shares off the back of that news lost 2.5%, and the Nasdaq hit its low of the session as a result of the news. For more on what's happening stateside, we are joined by Joseph Sroka, Chief Investment Officer and co-founder at NovaPoint Capital. Good morning, Joseph. Or good evening in your neck of the woods.
Morning, Emaad. Everything's good here, Emaad. How are you?
Yeah, well, thanks. Let's talk about the broad market indexes then. So a 7-day winning streak snapped for the S&P 500. Was that a surprise to you?
Not really a surprise. I mean, as you just mentioned, 7-day winning streak. The market doesn't go straight up. Pullbacks tend to be healthy. They allow investors entry points if they didn't feel like chasing certain issues. So I do think that's healthy. And the other thing I think we're seeing a little bit is, a little bit of sector rotation. Obviously, information technology, communication services had been leaders in the tech space where all your Mag 7 names are. So to see things like utilities and healthcare do better, I think that's refreshing and healthy for broadening of leadership in the market.
Yeah, broadly speaking, I think the markets have been quite resilient in the face of the U.S. government shutdown, which has now entered its second week. This after the Senate, for a fifth time on Monday, failed to pass a House bill that would have funded the government through November the 21st. Now, not only, Joseph, has it delayed the release of key economic data, but it also means that certain workers, like those in the TSA or air traffic controllers, are not getting paid. Active duty members of the armed services also won't get paid if the stoppage doesn't end by the middle of next week. So are we heading into dangerous territory?
I don't think we're heading into dangerous territory. The average government shutdown, it seems strange that there's average government shutdowns, have lasted a little over 7 days in the United States. There's actually been 21 of them since the late 1970s when we sort of went through this legislative budget process. So they do happen. They do last, like I said, about 7 days. And there's been an impasse so far. I think the point you brought up about, when we get to mid-month in October and there's the potential for military members to miss their paychecks, that puts a lot of pressure on politicians. It's not a great political move to grandstand, especially if it's seen as really just, party against party trying to score points. That doesn't sit well with the American people. So I think the combination of the military members needing to get paid plus the Congress, the lower house, House of Representatives coming back into session, who had already passed a continuing resolution to fund the government, could sort of be a catalyst to get this over with, within the next week or so.
Yeah, do you think the current uncertainty surrounding the government shutdown could put more investor attention on the Fed minutes, which are due Wednesday afternoon, as well as the commentary expected this week from several Fed officials?
Yeah, certainly when there's a void of economic data, we missed the monthly employment report last Friday. If this drags on, we're going to miss the key inflation reports next week, the consumer price index and producer price index. So investors are naturally going to gravitate to whatever news is available to digest and make investment decisions with. So certainly the Fed is independently funded. They don't get shut down. So, we'll see Fed minutes, and certainly at the end of the month, we'll have a Fed policy meeting with a rate decision. That happens regardless of whether the government is open or not. So, yeah, I think that all gets more emphasis. And then I think, what's most important to investors, especially equity investors, is we're going to get into earnings season. And once there's actual earnings to grasp onto and make decisions about, then a lot of the macro or peripheral information doesn't really drive markets as much.
Yeah, and come the end of the month when the FOMC does convene for that interest rate meeting, do you expect things to go as planned, i.e. a rate cut of 25 basis points?
Yes, even not seeing the data, the impetus for the rate cut last time was that the labor market has been weaker. We had that big restatement of labor numbers. So certainly the Fed is trying to be proactive now to make sure there's not a slide. Government workers getting laid off, contractors to the government, having to lay off workers. That's not good for the employment situation either. So certainly if the Fed wants to protect the labor market, then a 25 basis point cut would be in order. And if we look at, the Fed funds futures, they tell us right now investors expect 25 basis points in October and December, which is the following Fed meeting, perhaps skip the January meeting, but still be a rate cut before the end of the first quarter. Obviously, once we get back into the flow of economic data, people will recalibrate.
Yeah, in the absence of said economic data, we also have Q3 earnings to look ahead to. They get underway this week. We've got some reports from Pepsi and Delta Airlines, and next week we have the big banks, JP Morgan, Goldman Sachs, etc. What are your expectations on that front?
Yeah, so certainly, we're going to see high single-digit earnings growth out of the S&P 500 as a proxy, about 8% year over year, with revenue growth around 6% year over year. And a lot of the sectors we were talking about, the tech sector, is going to have the highest earnings growth because of all the activity we see in AI and other, technology issues. But, utilities, materials, industrials, they should all be pretty strong as well. And they're all benefiting from the infrastructure build out, as it relates to AI and the need for electricity to power data centers and electric vehicles and everything else that runs off electricity these days. But I really think there's obviously going to be some focus of, did the tariffs have an impact? How's the U.S. consumer doing? Are there enough inflationary pressures to perhaps have the Fed change their mind on monetary policy? And certainly, as you talked about Oracle earlier in the program, what really is the progress of AI? Are companies seeing a return on their investment dollars?
Let's shift gears a little bit and talk about gold. Now, prices have risen about 50% this year as the U.S. dollar index has dropped 10%. And on Tuesday, bullion prices hit 4,000 for the very first time. Clearly, investors seeking a safe haven from a weaker dollar. Do you expect more upside for gold?
It depends, right? If interest rates continue to decline, right, money goes somewhere. We have a lot of money in money market funds on the sidelines in the U.S. That could go to the equity markets. That could go to gold and other precious metals. It could go to other real assets like real estate, or certainly it could go into longer duration fixed income. So typically when we see a weaker dollar, we do see a bid for gold. Most of the global commodities that are dollar priced appreciate when the dollar declines. When I think about it as an investor, gold is a store of value. I sort of get the whole theory behind it. If I, was interested in dollar play, maybe a basket of metals that include industrial metals, to include silver, to include platinum, to include copper, I think makes sense from an investment standpoint. If you have an apocalyptic outlook and, you want to hold on to that gold, go get yourself some physical gold, because certainly you're going to have a hard time redeeming your gold ETF if we're in a really bad scenario. Yeah,
fair point. What else should investors be looking out for in terms of how they should position themselves strategically in the current environment, Joseph?
Yeah, like we said, the markets rallied through a government shutdown, and we had 7 days of good progress here headed into earnings, even though we had a pullback today. I think regardless of whether maybe AI gets a little out of itself or, spending on data centers get a little ahead of themselves, it's a long-term theme. It's not dissimilar from, digital communications, from the internet. So it's going to be a long-term play. Take advantage of the pullbacks. And as I mentioned last time I was on the show, we tend to look at AI just not as the tech sector. We have a cross-sector approach. Certainly, if you're a more income-focused or conservative investor, right, there's REITs, real estate investment trusts, that house data centers. There's utilities which pay nice dividends, which would also benefit as rates come down, that supply energy to the sector. And, as utilities need to spend on CapEx, electrical equipment and components in the industrial sector should all do well. So we sort of think of, the progression into AI as a supply chain, and there's all elements along the supply chain that investors can participate.
All right, a basket of options for investors then in the current environment. And we've been in conversation with Joseph Sroka, Chief Investment Officer and co-founder at NovaPoint Capital. Joseph, as always, thank you so much for sparing the time.
Thank you. Have a great day.
Yep, you too. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3.